Welcome to our third quarter results presentation. With winter coming for many people and energy prices high, consumers and businesses have been trying to find solutions. This requires collaboration across all parts of our society, so we continue to engage with governments to help make their new policies effective and avoid unintended consequences in the energy markets. A good example of such collaboration is our gas storage agreements for the upcoming winter in Europe, particularly in Germany and Austria. And in the Netherlands, we have started to supply liquefied natural gas to the recently created LNG import hub. We have also been providing support to our customers. For example, we have increased the hardship fund for our Shell Energy retail customers, and we will double the payment of the government's Warm Home Discount scheme to the account of more than 150,000 customers in the UK. To address the short and long-term energy needs, we must have a resilient portfolio of assets. We will achieve this through focused and competitive investments in a disciplined manner. For example, we are further growing our partnership with Qatar Energy with our involvement in the North Field South expansion. And we took a final investment decision on developing the Rosemary Marjoram gas project in Malaysia, which will be primarily powered by renewable energy. Once built, the offshore platform will use power from 240 solar panels, whilst the onshore plant will be connected to the Sarawak grid system, supplied from hydroelectric plants. Also, we announced the acquisition of Shell Midstream Partners in the US to further simplify our organisation. We are more disciplined, and that sometimes means taking tough decisions when activities don't meet our investment criteria or don't perfectly fit our strategy. For example, in the US, we have sold our majority interest in the oil and gas company Era Energy. We have ended our participation in the early stage wind projects in Ireland, and we have withdrawn from a deal to take liquefied natural gas from developer Tellurian. We do not take these difficult decisions lightly. When I think about focus and competitiveness, I also think about our marketing business update earlier this month. Our marketing business reaches millions of customers with a vast range of products and services. We are already number one in many areas and intend to be competitive in the emerging ones, such as e-fluids, electric vehicle charging, as well as biofuels. These solutions will especially help sectors that are hard to decarbonise. Over the past 3 years, around half of marketing's combined capital and operational expenditure went towards activities that generate low-carbon products. Impressively, these activities contributed almost 60% to marketing's earnings during the same period. With all these offerings, marketing has that perfect combination of strong growth and returns, diversifying our portfolio. It is the quality of our portfolio, together with our strong operational delivery, that has allowed us to significantly increase our shareholder distributions this year. We have now completed $6 billion of share buybacks for the third quarter, and today we are increasing our shareholder distributions even further. We have announced a new $4 billion share buyback programme, which we expect to complete by our Q4 results. This is expected to bring our total announced shareholder distributions for 2022 to $26 billion, in excess of 30% of our CFFO for the last 4 quarters. Through our share buybacks announced in 2022, we expect to repurchase some 10% of our share capital. And as indicated before, the reduction in share count allows us to increase our dividend in the future. So today, reflecting our progressive dividend policy, we have also announced our plan to increase our dividend per share by an expected 15% at Q4 results, subject to board approval. These increased distributions show our confidence in our business, its ability to fund both our energy transition and our shareholder distributions. Now let's see the results for the quarter. In the third quarter, we delivered robust results in a volatile market environment. Our adjusted earnings were $9.5 billion. In integrated gas, after a strong first half of the year, adjusted earnings were lower compared with the second quarter, primarily driven by trading and optimization. Due to increasing market volatility, there was a significant dislocation in historically correlated gas markers. This dislocation arose as a result of Russia's invasion of Ukraine and the subsequent impact on the energy markets and regional gas prices. Our trading and optimization organisation manages risk through hedging our physical volumes. Due to a breakdown in correlations, some hedges were less effective. LNG trading and optimization were also impacted by a combination of seasonality and supply constraints, where the business is geared towards supplying the Northern Hemisphere during the winter. Our upstream business performed extremely well, delivering $5.9 billion despite a decrease in Brent prices since the previous quarter. Our focus on value over volume, as well as operational excellence, continues to deliver strong cash flows and earnings. To give you an example, this quarter in our operated assets in the Gulf of Mexico, we achieved the highest production in a decade. This quarter, we delivered a very strong adjusted EBITDA of $21.5 billion, and our cash flow from operations was $12.5 billion. Working capital outflows were mainly due to seasonal gas inventory buildup, as well as higher initial margin requirements in renewables and energy solutions. That brings me to our financial framework. Our capital allocation priorities are unchanged. We will remain disciplined and invest in opportunities that align with our returns framework. This year, we expect our cash capital expenditure to be in the range of $23 to $27 billion. Another important aspect of our financial framework is net debt. It is now around $48 billion, which is slightly higher than last quarter. Having a strong balance sheet and maintaining AA credit rating remains one of our priorities. So this quarter clearly shows our financial framework in action, and we have demonstrated discipline and focus in managing our investments and financial position. We have confidence in our business and its delivery, which is why we are enhancing our shareholder distributions with new share buybacks and planned dividend increase for the fourth quarter. As we transform our business, we will continue to deliver the secure supply of energy that the world needs today and in the decades ahead. Thank you.